Hello and welcome back to the Lazy Money Game. In today's episode, I will walk you through my portfolio and what has happened this week, and afterwards I will answer some questions which I have received from the audience. So let's start by getting an overview of my portfolio and what I have actually done to it. The first thing you see is that I have added a lot of money into the portfolio. In total, it's $23,000. The second thing you notice is hopefully the percentage change in the portfolio. Since last week I was down almost 5% until today, where I'm down 0.45%, meaning that the capital gain this week has actually been quite substantial. So we have almost covered what we lost in the first 2 weeks. If we then take a closer look of what I have actually added to the portfolio, you immediately notice that I have added 2 new companies, which is 3M and CVS Health Corp. Besides that, I have added $3,000 into Disney, $1,000 into Wells Fargo, $2,000 into Bank of America, $1,000 into Synchrony Financial, $2,000 into Prudential Financial, and $3,000 into AbbVie. If we look a little closer to 3M, then if you are completely new to this dividend growth investing, you might not know what that company is all about. But if you are in the dividend investing society, then I guarantee that you will know this company, since this is what is known as a dividend king, meaning that they have been consecutively increasing their dividends for more than 50 years. Actually, they have been increasing their dividends for 61 years in a row, meaning that it fits immensely good with this strategy. And currently I think they are at a very attractive price, because if we go and look to the summary here and go 5 years back, we can see that the price is actually quite low compared to where it has previously been. And if we then go and take a look at the dividends tab and look at the dividend yield, we can see that we are currently trading at a very good dividend yield compared to the 4-year historic average. So currently I think it's an attractive price to buy at. This is of course no guarantee that the company won't drop in the future, or a promise that the company will actually go up in value in the future. But currently I think it's an attractive price to buy it at, and it's rare that a dividend king actually comes for sale, because you usually have to buy them at a premium. So what does 3M actually do? Well, if we look at the peers tab on Seeking Alpha, we see that they are located in the industrial sector, and that it's quite a big company with 96,000 employees. If we take a look at their webpage, we can see that they have all sorts of different product lines. In fact, they are selling more than 60,000 different products. So many people might say, oh, the company which produces tape, or the company which produces post-it notes. Oh well, that was just 2 out of more than 60,000. Of course, this was just a very, very brief overview of what the company is actually doing, but I highly suggest that you go out and discover it for yourself on their webpage, just to get a grasp of what they are actually doing, since there's so much. So I think it's fair to say that they have quite a good moat, and I truly believe that they are relevant today and will be so in the future. But of course, currently they are struggling, and that's why the share price is down. But in long term, let's say 5, 10 or even 15 years from now, I think that the company would be worth more. And in the meantime, I will be happy to collect my more than 3.5% in dividend. Next, let's take a closer look at CVS Health Corp. If we just take a quick glance of the stock price, we can see that it has actually been down quite a lot over the last year. But if we go to the 5-year historical average, we see that the stock is starting to rise again in value, but we are still lower than what we have seen previously. And at the current PE ratio of just above 10, we are still way below the average of the S&P 500, which is currently at around 25 in PE. If we then take a look at the dividends tab, we see that we're not completely fulfilling the guidelines since we are below 3% in dividend yields. But at the same time, the payout ratio is quite low, meaning that there is actually a lot of room to grow the dividends in the future. And if we take a look at the dividend yields, we can see that the price that I'm currently buying at is still below the historical 4-year average, meaning that I get a better dividend than what I would have done on average over the last 4 years. And just to give you some more nuances, let's go to the ratings tab and see, and then the sell side rating, and then see what the analysts are actually thinking about this stock. We see that 10 are neutral, 5 are bullish, and 13 are very bullish, meaning that the stock is currently trading at 71 and they believe that it should actually trade at 82. So there's also room for a capital gain in this case as well. As always, this is no guarantee that the stock will grow in the future or that you will actually make money by buying this company. So I highly suggest that you go and check out their webpage. I will put the link in the description below. But simply also just sharing it here, saying cvshealth.com, and then you can go and look into the history tab and see what the company is actually all about. And I, as always, recommend that you go in to the investor page and check out the financial results to have a look at the numbers and see whether or not you think that this could actually be a good buy, just to see if you're actually agreeing with the analysts. I think a fair question to ask at this point is, why was I so bullish and adding so much more into my portfolio? And I think if you watch my last episode, you actually know the answer. Just because I believe that history is actually currently repeating itself. Meaning that everyone feared that this coronavirus would spread immensely and will continue to drive the stock market down. But as soon as we saw the announcement from the World Health Organization, we actually calmed down the market and it started to increase in value. And there's actually a good reasoning behind that. So if we go and take a look into the situation reports and look at some of the newest reports, we see up here that the number of confirmed new cases is between 3,000 and 4,000, meaning that now we are actually growing linearly and not exponentially as somewhat might feared. And as a result, you can see that my portfolio is actually gaining quite a lot of value compared to what I have lost previously, meaning that my portfolio almost is fully recovered from the losses before the announcement from the World Health Organization. But the thing which I am by far the most excited about is these 3 emails which I have received from Seeking Alpha, stating that 3M has increased their dividend by 2%. Suncor Energy has increased the dividend by 10.7%, and Prudential Financial has increased their dividend by 10%, meaning simply just by holding these companies, I will make more money in the future. This is actually what the strategy is all about. So happy to share that with you. So let's look at the first question that I have received. Why have you chosen to go with dividend growth investing? This is actually a long question to answer. So let me try to explain it as briefly as I can, but still highlighting some pros and cons by different investing strategies. So if we start by looking at day trading. The pros about day trading is that it can be very profitable in the short run. Earnings compound much faster, since whatever you made the day before, you can go and invest the next day. You get much more excited and much more emotional about it because you feel like a god every time that you're doing it right. The cons are that not all conditions are great for day trading, meaning that it really depends on what is going on in the market, whether or not it can be profitable to do day trading. You need a lot of volatility in the market in order for this to be a good strategy. The support and resistance levels are not well defined, meaning when you're sitting and day trading yourself, you're actually sitting and trading against highly sophisticated algorithm programs, and they are faster than you, without a doubt. it's much more stressful, and you have to have constant attention when you sit and do day trading. Fourthly, the market hours might not work for you, meaning if you actually want to keep a day job besides your investing, it's maybe not possible, since you simply have to sit in front of the screen all the time. And since you're trading so much, commissions tend to go up really quickly. Let's look at growth investing. Some of the pros are the possibility for really high returns if you manage to find the company which would successfully outgrow its competitors. Then it will be possible to make a substantial amount of money. For instance, if you have bought Netflix 10 years ago, you would have received 43 times your money today than what you have invested 10 years ago, meaning 10,000 would have turned into 430,000 in just 10 years. Secondly, there is no tax until you sell, meaning whatever the company is making will stay in the company, since they're not paying out any of its profits to you, and you will only be taxed when you decide to sell the company. Some of the cons are it requires a lot of time to sit and evaluate every single company that you potentially want to buy. And keep in mind that you will have to do this constantly, since the company is not paying out anything. So in order to determine whether or not you want to hold or sell the company, you constantly need to evaluate whether or not you think that the company is going to be profitable going forward. Secondly, you might be tempting to sell when the market crashes, or more tempted to sell, I should rather say, since you won't gain any money, since everything is bound by capital gains, meaning that if the market crashes, you can see all the wealth you have gained go down the drain. Now, let's look at the dividend growth investing strategy. Some of the pros: you will get good return in the long run, at least if you look at the historical perspective. I will provide a link to a website that shows a study that has been going on since the beginning of the 19th century. And secondly, it's really a passive way of investing. Some of the cons are that you will be taxed every time that you get a dividend, meaning that you would be taxed much more frequently than you would if you were just doing a regular growth investing strategy. But for instance, in Denmark, there could be some benefits for being taxed a little more frequently, so that you are not forced to sell everything in order to optimize the tax that you have to pay from capital gains. Secondly, it takes a lot of time to start the portfolio, since you still need to do the research in order to determine which companies that you actually want to add to your portfolio in the beginning. But once you have done your research, it starts to pay out, because you simply just sit and monitor your portfolio instead of having to constantly look to say, do I need to buy or do I need to sell? Because when to sell is actually quite simple, as I highlighted in episode number 2. So to sum up, if you look at day trading, I really do not think that this is for everyone. You almost have to be a professional investor. Oh, and by the way, you can't do day trading if you decide to go with the app that I'm using, because they simply do not allow it, which I'm actually quite a big fan of. And if you take a look at some of the quotes from some of the best value investors out there, for instance, Charlie Munger, Warren Buffett's right hand, he actually thinks that it's much more harmful to young people to do day trading than it would be if they were starting on heroin, just to give you an idea. Growth investing, well, it could be a combination of growth investing and dividend growth investing, but I think that growth investing still requires more research and more time in front of the screen, simply because you need to try and time the market much more than you have to do with dividend growth investing. Of course, you can always argue that you will still need to try and time the market when you buy your first tranches of the stocks into your portfolio. So hopefully this answered the question about why I have chosen to go with the dividend growth investing strategy. Simply because it's the strategy which I found most appealing to the broader audience, since day trading is only for a very selected few people, in my opinion. Growth investing would require more time, and dividend growth investing is simply about making passive income. And since this channel is called The Lazy Money Game, I think it's very obvious that it's the only choice that I have. And I actually like it. I'm very well aware of the fact that I will miss out on good deals like Netflix or Tesla, but I'm not trying to foresee which company will perform much better than everyone else, because I do not know what is going to happen tomorrow. So I am actually willing to accept a lower return simply just because I do not have the skill set in order to pick out those companies. The next question I have received is about a concept known as FIFO, and what does it actually mean? So FIFO stands for first in, first out, meaning whatever you buy first is also the thing that you're selling first. So let's look at an example. If you have two tranches, meaning that you have bought stock over 2 times, the first time you bought it, you bought for instance 10 stock at a price of 50, which gives a total price of 500. The second time you bought the stock, then you decide to buy 20 stocks, but the price has gone all the way up to 100, meaning that you have to pay 2,000 for that one. If you then decide to sell 20 shares, then you need to calculate the average buy price for the 20 lots that you're selling. So the first 10 lots you bought for 50, the second 10 lots you bought for 100. Hence you go and calculate the total buy price, which adds up to 1,500, and then you're saying you're selling 20 lots at a price of 80, which is 1,600. So your total earnings comes down to 1,600 minus 1,500 equals 100. So that concludes yet another exciting week on the stock market, and hopefully you feel more encouraged to start by doing your own dividend growth investing strategy, since I have tried to answer the question for why I have chosen to go with this strategy in this episode. And as always, remember to like, subscribe and comment in order for me to try and answer as many questions as I possibly can. And until I see you next time, bye!